Your bank account is about to experience something most people will not see coming. And by the time you understand it, the damage will already be done. There is a number that just became the most important thing in your financial life right now in 2026. $100 trillion? That is how much the world collectively owes right now at this exact moment. And that number just got a debt crisis attached to it because $100 trillion in government debt cannot absorb a major shock to the system. It amplifies shocks. It turns regional problems into global recessions that ripple across every continent. And that is exactly what the Middle East conflict is about to trigger in the coming months and years. Not because of the war itself, because of what the war costs to fight, because of the spending, because of the money that must be borrowed. The mechanism is brutal, and it is already in motion right now as we speak. 20% of all oil traded on Earth moves through one strait and only one strait. One, the Strait of Hormuz. When that strait gets unstable, there is no plan B and there is no alternative route. Oil does not drift up slowly and gradually. It gaps immediately. It spikes violently. In days, not weeks or months. Brent crude moved from $90 to $170 in a matter of days and weeks. That is not a price change on a spreadsheet. That is a shock to every economy on the planet. And here's what nobody is explaining to you right now. When oil moves that fast, it is not just a price change on a chart somewhere in a financial terminal. It is a transfer of purchasing power from one set of nations to another. It is immediate and it is irreversible. Consuming nations, the United States, Europe, Japan, India, China, they all pay more for the same energy input that they need to run their economies. That money leaves their domestic economies instantly and goes to producing nations. It tightens financial conditions without a single rate hike from the Federal Reserve or any central bank. It is a hidden tax on growth that shows up everywhere in the economy simultaneously. Now combine that with $100 trillion in debt. Think about what happens next. Government revenues begin to fall because economic activity slows under higher energy costs. At the exact same time, government expenditures explode because citizens cannot afford those higher costs. Heating subsidies, fuel caps, direct payments, tax relief. The gap between falling revenue and rising spending is the deficit. And deficits at this scale do not get funded with savings. They get funded with borrowing. The United States entered this year projecting a $1.9 trillion deficit. That was before war-related spending. Congressional budget discussions are already floating an additional $200 billion in military and logistical spending tied directly to the conflict. That pushes the deficit toward $2.1 trillion in a single fiscal year. Every single dollar of that is borrowed. U.S. national debt interest payments have already crossed $1 trillion annually. Let that sink in. The United States is now borrowing money to pay interest on money it already borrowed. This is not theoretical. This is exactly what Goldman Sachs outlined in a recent client note where they warned that fiscal dominance risk is rising. Fiscal dominance means central banks lose control because governments require low rates and liquidity to service debt. When that happens, inflation is not a possibility. It is the policy. Look at Europe, because the transmission mechanism is even more visible. Natural gas prices across the continent surged over 70% within weeks of escalation. Europe still relies on gas for roughly 20% of its energy mix. 1/3 of households depend on it for heating. Storage levels dropped toward 30%, the lowest since the 2022 energy crisis. Governments are already discussing renewed subsidy packages that could exceed 300 billion euros if prices remain elevated into winter. That 300 billion euros does not exist. It will be borrowed. And here's the problem nobody is talking about. France is approaching 130% debt to GDP. Germany, usually the responsible one, is hitting 80% and climbing. Both countries are competing for the same borrowed money. The bond market is watching. Borrowing costs just hit their highest in over a decade. And this is where the system starts to fracture. When multiple large economies borrow simultaneously to fund non-productive emergency spending, they compete for the same pool of capital. That pushes yields higher. Higher yields increase debt servicing costs. Higher servicing costs expand deficits further. Expanded deficits require more borrowing. This is not a cycle that stabilizes. It accelerates. Drop a comment below. Where are you watching from? Japan is the clearest example of how this breaks in real time. Japan imports over 90% of its energy. When oil prices spike, the impact is immediate and unavoidable. The government implemented gasoline price caps to shield consumers. At $120 oil, the cost of that policy was estimated at $40 billion annually. At $170, internal estimates suggest that number exceeds $70 billion. That is for one policy in one country. Gas stations in multiple prefectures have already suspended operations because they cannot operate profitably under capped prices. A business that cannot pass through costs does not adapt. It shuts down. A public bathhouse that operated for 27 years closed because heating water became unprofitable. A logistics company postponed wage increases because fuel costs consumed operating margins. These are not isolated anecdotes. They are early indicators of systemic strain. The Japanese yen weakened to 158 against the dollar, making dollar-denominated energy imports even more expensive. That creates a second-order effect. Currency weakness amplifies commodity inflation, which forces more intervention, which requires more borrowing, which weakens the currency further. This is how advanced economies begin to behave like emerging markets under stress. Now step back and look at what is happening everywhere at once. The United Kingdom is preparing additional heating subsidies. New Zealand has already deployed direct cash transfers of approximately $120 per month to lower-income households. China has implemented targeted fuel price controls while restricting exports to preserve domestic supply. Hungary and Slovakia have limited fuel access to citizens only to prevent cross-border arbitrage. Slovenia imposed rationing after becoming an unintended subsidy provider for neighboring countries. Every one of these actions has a cost. None of these costs are funded with surplus. They are funded with debt. This is the piece that matters. The war is not the core problem. The war is the catalyst. The core problem is that $100 trillion in sovereign debt cannot sustain a synchronized global response that requires additional borrowing across every major economy at the same time. A senior strategist at JPMorgan Chase described this privately as a liquidity illusion. The system appears liquid because credit is available, but that liquidity is contingent on confidence. When confidence in sovereign balance sheets begins to erode, liquidity disappears exactly when it is needed most. And that is where we are heading. Because there are only three ways to resolve sovereign debt at this scale: default, austerity, or inflation. Default for major economies would collapse the global financial system. Austerity in the middle of an energy crisis is politically impossible. That leaves inflation as the only viable path. Inflation is not an accident that happened by random chance. It is not a mistake made by policymakers who do not understand economics. It is a solution. It is a deliberate policy choice masquerading as an accident. When governments print currency to fund deficits, they reduce the real value of outstanding debt without technically defaulting. They do not say this publicly because it would sound awful. But the mechanism is well understood at every major financial institution like Bank of America and Citigroup and Goldman Sachs. Controlled inflation is the only politically acceptable way to deleverage a system that cannot repay what it owes in real terms. But inflation is not controlled in a shock environment, and that is the problem. When you have a major exogenous shock like an energy crisis, inflation spreads everywhere uncontrollably. Energy feeds into transportation. Transportation feeds into food. Food feeds into wages. Wages feed into services. Everything feeds into everything else. What begins as an oil shock becomes a full-spectrum inflation cycle that affects every sector of the economy simultaneously. Central banks cannot tighten aggressively into that environment without triggering a debt crisis because higher rates increase the cost of servicing $100 trillion. So they hesitate, they pause, they talk about data dependence while inflation embeds itself into the system. This is the point where the narrative breaks for most people watching right now. They are waiting for the war to end, thinking everything resets. They believe a ceasefire resets prices, resets markets, resets the entire system back to normal. It does not work that way, and that is where most analysis fails. Because the damage is already embedded in the balance sheets of every government and every central bank. Debt accumulated during the crisis does not disappear when the crisis ends and the war ends. It remains on the books forever. It compounds. It requires servicing for decades. And servicing requires either higher taxes on populations that cannot afford them or more printing of currency. That is where the next phase begins, the difficult phase, the phase where governments must reckon with what they spent. What comes after the war is not recovery and growth like most people hope. It is reconciliation with the cost of what was spent to survive the conflict. And historically, that is always the phase where currencies fail catastrophically, and real assets begin their most aggressive repricing cycles that reshape entire economies. The transition is mechanical, and it is already starting. Most of the borrowing tied to this conflict has not yet fully entered the system. Appropriations are being approved right now, subsidies are being structured, bonds are being issued. The full monetary impact lags the initial event by months. By the time it is visible in inflation data, the positioning phase is already over. That is why institutional capital moves ahead of confirmation. They do not wait for CPI prints, they model flows, they anticipate policy, they position accordingly. The retail investor waits for clarity, and by the time clarity arrives, the repricing has already occurred. That is the divide. The final piece is the misconception that resolution of the conflict resolves the economic consequences. It does not, because the economic consequences are not tied to the duration of the war. They are tied to the scale of the response. The money has already been committed, the debt has already been issued, the obligations already exist. Ending the war does not reverse those transactions. It simply transitions the system into the phase where it must carry them. And carrying them at 100 trillion and rising requires one outcome above all others: currency expansion. Not because policymakers prefer it, because the math leaves no alternative. And currency expansion sustained over time is the single most reliable driver of higher asset prices in recorded financial history. The numbers we are discussing are not hypothetical. They are documented across Federal Reserve data, Treasury Department releases, and International Monetary Fund publications. The Congressional Budget Office has already flagged fiscal dominance as a primary risk to monetary policy effectiveness over the next 5 to 10 years. The Bank of England has begun stress testing scenarios where energy shocks combined with elevated debt trigger stagflationary spirals. The European Central Bank is privately modeling debt sustainability across member states under various recession and inflation scenarios. These are not academic exercises. These are emergency preparations. Because when you look at the actual balance sheets, when you examine the real numbers without the spin, the picture becomes undeniable. Global debt service is consuming larger percentages of government revenue in every major economy. Central bank independence is being tested. Currency stability is under scrutiny. The margin for error has become razor thin. And the war is the stress test that reveals every weakness. In Part 2, I'm going to show you exactly how that transition happens, why post-war environments are significantly more dangerous than wartime conditions for financial markets and investors, and why the 100 trillion number you just heard is not the ceiling or the final number. It is the baseline. It is the foundation of what comes next and what is already beginning to unfold across global financial markets. The inflation that is coming will not be temporary. The debt that has been accumulated will not disappear. The repricing of assets that is inevitable will reshape portfolios and determine who preserves wealth and who loses it. The most dangerous phase of every major crisis in history is not the event itself. It is the aftermath, when the spending stops being urgent and starts being accounted for in real dollars and cents. That is when governments are forced to confront what they borrowed, what they owe, and what they can realistically repay with their tax revenues. And that is when policy mistakes compound into systemic consequences that reshape entire economies and redistribute wealth across generations. After the war, the immediate justification for emergency spending disappears, but the liabilities remain on the balance sheet forever and ever. Governments will face deficits that are structurally higher than they were before, debt levels that are historically unprecedented in peacetime, and interest expenses that are consuming larger and larger portions of national budgets every single year. The response pattern is not theoretical. It is documented across every major post-war period in modern financial history. It always follows the same sequence. First comes the attempt at austerity that sounds good, but fails catastrophically. Governments begin signaling fiscal discipline to calm markets. Spending cuts are proposed, taxes are discussed, social programs are reviewed for efficiency. But here's the constraint that breaks the entire plan every single time. The economic environment they are operating in is already weak from the shock. Growth has slowed under the weight of elevated energy costs and disrupted supply chains. Households are financially strained and savings are depleted. Businesses are operating on compressed margins with no room for error. Cutting spending or raising taxes in that environment does not stabilize the system. It contracts it immediately. It triggers recession. This is exactly what happened after World War I when austerity was imposed across Europe. And it happened again in multiple European economies after 2010 during the sovereign debt crisis. Fiscal tightening into economic weakness produces recession. Recession reduces tax revenues because people lose jobs and stop spending, which widens deficits again. So the very policy designed to fix the problem makes the problem much worse. It is a trap with no exit. Second comes monetary accommodation that sounds helpful but enables crisis. Central banks facing a slowing economy and rising fiscal stress begin to ease conditions dramatically. They pause rate hikes, they signal future cuts, they expand liquidity facilities, they lower reserve requirements. But they cannot fully normalize policy because inflation driven by the earlier energy shock has not fully subsided yet. This creates a condition where inflation remains elevated while growth deteriorates simultaneously. That condition has a name: stagflation. Stagflation is the worst possible macroeconomic environment because it breaks every traditional policy tool at once. Raising rates slows growth further and triggers a debt crisis immediately. Cutting rates reignites inflation. Fiscal stimulus increases deficits beyond control. Fiscal tightening deepens recession. There is no clean solution. There is no exit. Now layer in the scale. This is not one country dealing with stagflation in isolation. This is multiple major economies experiencing it simultaneously, all carrying historically high debt loads, all attempting to manage the same set of constraints at the exact same time. This is where currencies come under severe pressure from all directions. Because when growth is weak, debt is high, and inflation is persistent, the real return on holding currency becomes deeply negative. Investors, both institutional and private, begin reallocating away from cash and sovereign bonds into assets that can preserve purchasing power. This is not speculation or gambling. This is allocation behavior observed in every inflationary cycle in recorded history. Pension funds, sovereign wealth funds, and high net worth portfolios are already increasing exposure to commodities, precious metals, and real assets right now. At Goldman Sachs, commodity strategists have already outlined scenarios where sustained supply disruption combined with underinvestment leads to multi-year commodity bull cycles. Energy, metals, agricultural products. These are not short-term trades. They are structural reallocations happening in real time. Gold sits at the center of that shift because it is not just a commodity like wheat or oil. It is a monetary asset. It does not carry counterparty risk. It does not depend on earnings. It does not default like government bonds. When confidence in fiat systems declines, gold absorbs that demand instantly. Historically, during periods of fiscal expansion and monetary accommodation, gold does not rise linearly on a straight line. It reprices in stages: sharp moves, consolidation, then continuation. The last major cycle saw gold move from $250 in 2001 to over $1,900 by 2011. That was driven by a fraction of the debt expansion we are seeing today. Now consider the current baseline: $100 trillion in sovereign debt, deficits expanding, central banks constrained, energy markets unstable. The scale is exponentially different. The velocity is different. The outcome based on precedent is not subtle. It is aggressive. Drop a comment below. Where are you watching from? Silver introduces an additional layer to this dynamic. Unlike gold, silver has a dual role. It is both a monetary asset and an industrial input. It is used in electronics, solar panels, batteries, and a wide range of manufacturing processes globally. When supply chains are disrupted and industrial demand remains stable or increases, silver experiences a squeeze from both sides simultaneously. Monetary demand rises as investors seek protection. Industrial demand remains or grows. Supply, constrained by mining output and logistical challenges, cannot adjust quickly. This is why silver historically outperforms gold in the later stages of monetary cycles. It is more volatile, but it is also more responsive to demand shocks. Now bring this back to the individual level, because this is where the abstract becomes brutally real. Every dollar of additional government borrowing eventually manifests in the economy somewhere. It shows up as higher prices, higher taxes, or reduced services. When governments choose inflation as the path of least resistance, the adjustment is not evenly distributed. It is borne by anyone holding cash or fixed income assets that do not adjust for inflation. Your purchasing power declines incrementally at first, then more rapidly as inflation compounds. Groceries cost more, energy costs more, insurance premiums rise, rent increases, wages lag behind prices. The gap between income and expenses widens. This is not a temporary distortion, it is a structural shift. The critical point is this: the majority of people respond to this environment reactively. They adjust spending, they cut costs, they attempt to manage within the system. The minority position themselves within it. They hold assets that reprice as the system adjusts. Gold and silver are not speculative in this context. They are functional. They are instruments designed to hold value when the unit of account is being diluted by central banks. This is why central banks themselves are accumulating gold at the fastest pace in decades. They understand the same dynamics. They are diversifying away from reliance on currencies that are being expanded to service debt. At Bank of America, internal research has highlighted that real yields when adjusted for inflation remain a critical driver of gold prices. When real yields are negative, gold performs strongly. In a stagflationary environment where inflation remains elevated and nominal yields cannot rise sufficiently without triggering a debt crisis, real yields stay suppressed or negative. That is the exact condition where gold historically accelerates upward rapidly. Now consider the timeline. The war triggers the shock. The shock forces borrowing. The borrowing expands debt. The expanded debt constrains policy options. The constrained policy allows inflation to persist. Persistent inflation erodes purchasing power everywhere. Eroding purchasing power drives capital into hard assets. Hard assets reprice. This is not a theory or academic concept. It is a sequence that has played out identically across centuries of financial history. And we are early in that sequence. Very early. Because most of the borrowing tied to this conflict has not yet fully entered the system. Appropriations are being approved right now. Subsidies are being structured. Bonds are being issued. The full monetary impact lags the initial event by months and quarters. By the time it is visible in inflation data, the positioning phase is already over. That is why institutional capital moves ahead of confirmation. They do not wait for CPI prints. They model flows. They anticipate policy. They position accordingly. The retail investor, the average person watching this, waits for clarity and confirmation. And by the time clarity arrives, the repricing has already occurred. That is the divide between those who preserve wealth and those who lose it. The final piece is the misconception about what happens when the war ends. Most people think resolution of the conflict means resolution of the economic consequences. It does not. Not even close. Because the economic consequences are not tied to the duration of the war. They are tied to the scale of the response. The money has already been committed, the debt has already been issued, the obligations already exist. Ending the war does not reverse those transactions, it simply transitions the system into the phase where it must carry them. And carrying them at 100 trillion and rising requires one outcome above all others. Currency expansion. Not because policymakers prefer it, because the math leaves absolutely no alternative whatsoever. And currency expansion sustained over time is the single most reliable driver of higher real asset prices in recorded financial history. The question is not whether the system adjusts. It will. It always does. The question is whether you are holding the assets that adjust with it. Because the war will end, the headlines will fade, markets will stabilize temporarily, but the debt will remain, the printing will continue, the repricing of real assets will accelerate. That is the phase most people miss. And it is the phase that defines who preserves wealth and who loses it. The phase that is coming. The phase that is already beginning. The phase that will reshape financial markets in ways most people will not see until it is too late. What you do in the next few months will determine whether you are positioned correctly for what is about to happen. The institutional players already know what is coming. They are moving now. They are positioning now. They are accumulating now. The question is simple. Are you moving with them, or are you going to wait until it is obvious? Because by then, the repricing will be over. The opportunity will have passed, and you will be left wondering how you did not see it coming. Do not be that person. Position yourself now. The timeline is shorter than you think. Thank you for watching part 2. If this analysis resonated with you, like this video and subscribe because more content on macro dynamics and financial positioning is coming your way. And if you have thoughts on how this unfolds, drop them in the comments. I read every single one.